Look at Cisco Systems today. I mean, is this stock like a strong buy riding a massive AI wave? Or are recent insider sell signals and cash flow dips pointing to a value trap just waiting to snare retail traders?
Right, and that tension, that's basically the defining story of the market right now. You look at the surface, and the momentum is historic, right?
Yeah.
But the moment you start disassembling the underlying financial machinery, the gears are grinding in ways that should make, well, any investor pause and look closer.
Totally. So, welcome to the deep dive. Today is April 14th, 2026, and our mission today is to dissect the financials, the technicals, and that shifting market sentiment behind Cisco Systems ticker symbol CSCO. We are going to dig through the actual data to help you understand what these numbers mean mechanically. We want to cut through the noise and figure out what is really going on with this legacy tech giant.
Exactly. Because in a market environment this volatile, reading a few headlines about AI simply isn't enough. You need the complete context of how money is, actually moving into and out of the company.
Right. And really quick before we jump in, like the video and subscribe to our YouTube channel. And it's compulsory that you leave your feedback in the comments. We want to know what you think.
Yes, please do. And just to establish a baseline for you listening, what we are doing here is a natural human analysis of the available data. This is absolutely not financial advice.
Yeah, definitely not.
We are examining the mechanics of the market, not telling you what to do with your portfolio.
Right. Okay, so let's lay out the current snapshot. Right now, Cisco is trading at $82.35.
Yeah.
And the momentum here is just staggering for a company of this size. I mean, the stock is up 8.96% in just the last 4 weeks alone.
It's wild.
It is. And if you zoom out, it's up 42.85% over the last 12 months. This is a massive run for a company that, for the last decade was mostly viewed as a slow, steady dividend play.
Right, exactly. A legacy networking hardware company that people bought for stability, not explosive growth.
Yeah, but now
the market is attempting to entirely reprice the company. And that's based on this massive influx of AI infrastructure orders. Wall Street is no longer valuing them as a company that just sells, like, office routers. They are trying to value them as the critical plumbing for global artificial intelligence data centers.
Okay. But to understand if that 42% climb is actually justified, we have to start with the foundation, right?
We do.
We need to look at their most recent report card, which is the Q2 2026 earnings from February 11th. I am looking at the income statement, and I gotta say, the headline numbers are huge.
Oh, massive.
They reported record revenue of $15.3 billion, which is up 10% year over year. GAAP net income came in at $3.2 billion, a 31% jump, and earnings per share hit 80 cents. And here's the thing, I also see a non-GAAP EPS sitting higher at $1.04. Okay, let's unpack this. Why should we care about a 24-cent gap between GAAP and non-GAAP earnings? Like, what is the actual difference there?
Yeah, so GAAP stands for Generally Accepted Accounting Principles. It's the strict, standardized rulebook that every public company has to follow so investors can compare apples to apples.
Right, the official numbers.
Exactly. But companies also report non-GAAP numbers, which is basically them saying, here's what our earnings look like if you ignore certain one-time costs.
Okay.
In Cisco's case, that 24-cent difference is largely made up of stock-based compensation for employees, plus the massive integration costs from their recent acquisitions.
So it smooths things out.
Yeah, non-GAAP paints a smoother picture of their day-to-day operations,
Yeah.
while GAAP tells you the harsh, standardized truth of what actually left the company's accounts.
Got it. So on paper, using either metric, the company is highly profitable, and the balance sheet definitely backs that up. They have total assets sitting at $122.3 billion against liabilities of $75.4 billion. Plus, they are sitting on $15.8 billion in cash and investments.
It's a very healthy balance sheet.
Very healthy. But, and here's where it gets really interesting, and honestly where the story gets weird. They just reported a 31% jump in net income and $15.3 billion in revenue, right?
Yep.
But then you look at their operating cash flow, and it came in at $1.8 billion. That is actually down 19% year over year.
Yeah, that's the catch.
It's like getting a massive promotion and a raise at work, but somehow at the end of the month, you have 19% less cash in your actual physical wallet. How does a company report record net income but bleed operating cash flow?
Well, this is where we have to separate accrual accounting from cash accounting.
Okay.
When Cisco signs a massive contract to upgrade a data center, under accrual accounting, they recognize that revenue on the income statement pretty quickly.
Which boosts the net income.
Exactly. It boosts the
Yeah.
net income you just mentioned.
Mhm.
But actual cash flow is the literal money moving in and out of the bank account. Right now, to build all this AI infrastructure, Cisco has to purchase incredible amounts of raw materials. They're buying really expensive silicon chips and securing supply chains months before they actually deliver the finished hardware to their customers and collect the invoice.
So the cash is draining out of their accounts today to build the inventory they need to fulfill the orders they've already booked.
Precisely. They are front-loading the costs. So sales are booked, profits look phenomenal on the income statement, but the actual day-to-day cash generated tightens up because it's all tied up in warehouses and supply chain logistics.
Wow, okay. Keep the price context in mind as we discuss this, because over the last 52 weeks, Cisco stock has ranged from a low of $53.83 to a high of $88.19.
Right?
And at $82.35 right now, we are sitting incredibly close to the top of that 52-week mountain, all while that operating cash flow is dropping 19%.
Which is a huge red flag for some people.
Which makes me wonder, if the cash flow is tightening but the price is peaking, who is actually buying at these levels? Who is driving this price action?
Look at the order flow.
Yeah, a massive 82% of Cisco's shares are currently held by institutions.
Right. And when you see institutional ownership, that high, we're talking mutual funds, pension funds, ETFs, the stock kind of stops trading based purely on its own merits and starts trading based on index mechanics.
Interesting. How so?
Think of massive index funds like a commercial airliner on autopilot. They don't care if Cisco's cash flow dipped 19%.
Right.
If millions of retail investors are pouring money into a broader tech ETF, that ETF's autopilot system is basically forced to blindly buy more shares of Cisco to maintain its target weighting.
Wow.
Yeah, that blind mechanical buying creates immense upward price pressure that has nothing to do with Cisco's actual quarterly performance.
And while the autopilot is buying, the people betting against the stock are just packing up and going home.
Yeah, the shorts are retreating.
Big time. Short interest has decreased by 13.72% recently. We're looking at a tiny short float of just 1.4% and a days to cover ratio of 2.13. Can you explain that days to cover metric? Because it seems crucial for understanding the lack of panic from the short sellers.
Sure. Days to cover is a really simple mathematical ratio. It takes the total number of shares that are currently sold short and divides it by the stock's average daily trading volume.
Okay.
So a ratio of 2.13 means that if every single short seller suddenly panicked and decided to buy back their shares to close their positions, it would only take about 2 days of normal market volume to absorb all of those orders.
Which means...
It tells us there is very little risk of a massive short squeeze driving the price artificially higher. The shorts haven't been squeezed at all. They've just quietly stepped out of the way of the AI narrative.
But the shorts aren't the only ones moving. There is a glaring contrast hidden in the data
Now,
here.
the insider selling.
Yeah. Retail traders might be buying into the AI hype and the ETFs are buying on autopilot, but the insiders are cashing out. Between February and March of 2026, CEO Chuck Robbins sold $1.48 million worth of shares, and CFO Mark Patterson sold $381,000. If the guys who actually run the company, the guys who see the internal accounting, are hitting the sell button while the stock is near its highs, shouldn't we be panicked? I mean, if the stock is genuinely going to $100, why would the CEO sell at 82?
What's fascinating here is the massive disconnect between retail psychology and executive compensation. A headline screaming, "CEO sells shares," triggers primal fear for an individual investor.
Naturally.
But you have to look at the mechanics of how executives are paid. $1 million seems massive to us, but for the CEO of a $300 billion company, it is a tiny fraction of his overall holdings.
True.
Furthermore, executives at this level rarely just log into a brokerage account and hit sell. They use what are called 10b5-1 trading plans.
Ah, these are the predetermined schedules, right?
Yes, exactly. To avoid insider trading accusations, executives set up legal blind schedules months or even years in advance.
Oh, I see.
They essentially tell a broker, sell X number of shares on the 15th of every quarter, often just to cover massive tax liabilities from their stock options or just to diversify their personal wealth.
So it's automatic.
Right. They are selling because it is a Tuesday on their schedule, not necessarily because they think the company is doomed.
Okay, I get that. Even so, juxtaposed with an 82% institutional hold, the smart money seems to be comfortably taking profits. The insiders are trimming, the shorts have already left, and the stock is consolidating.
Yeah.
So let's look at the technical analysis to see if the charts are flashing weakness or strength. If you are trying to figure out if this is a safe entry point, the technicals tell a very specific story about the current trend direction.
They do. The overarching trend right now is textbook consolidation following a parabolic rally. After shooting up 42%, the stock has basically found a trading range. It is essentially catching its breath as buyers and sellers fight for a new equilibrium.
And the data gives us exact levels to watch. On the upside, key resistance is sitting at $85.65, and above that, the previous high watermark around $88.88. On the downside, key support levels for protection are $75.19 and $71.96. But why do these specific, seemingly random price points act as invisible ceilings and floors?
Well, support and resistance levels aren't magic, right? They are just a visualization of collective human memory and behavioral economics.
Oh, so?
Resistance at $88.88 exists because the last time the stock hit that price, a massive wave of investors decided it was too expensive and sold, which drove the price down.
Right.
Other investors who bought at $88.88 and watched it fall are now trapped. They're just waiting for the price to get back to their break-even point so they can sell without a loss.
Yeah.
That creates a ceiling of supply.
And support works the exact opposite way.
Exactly. Support at $71.96 is the price where, historically, institutional buyers stepped in and said, this is too cheap to ignore, which created a floor of demand.
Okay, that makes sense. But within that range between the floor and the ceiling, the momentum indicators are surprisingly neutral. Like, the relative strength index, the RSI, is sitting at 55.12.
Very neutral.
Yeah. And the MCD indicator is at 0.190, which is technically still flashing a buy signal. What are these indicators actually measuring?
So the relative strength index measures the velocity and magnitude of recent price changes on a scale from 0 to 100. If a stock shoots up too fast, the RSI climbs over 70, signaling it is overbought and due for a pullback.
Got it.
Below 30 means it's oversold. So sitting at 55 means the aggressive buying pressure has cooled off perfectly into a neutral or maybe slightly bullish state.
And the MCD?
The MACD, or moving average convergence divergence, is a bit more complex. It calculates the distance between a short-term moving average and a long-term moving average.
Okay.
When the short-term line crosses above the long-term line, it mathematically signals that upward momentum is accelerating, which triggers that buy signal you mentioned.
Right. Speaking of moving averages, they are all screaming strong buy. The current price of $82.35 is comfortably above the 5-day average of $81.76, the 50-day average of $81.14, and the 200-day average of $79.50. But I have to push back here. Moving averages are, by definition, lagging indicators. They calculate the past. If a stock jumps 42% in a year, of course, the current price is higher than the 200-day historical average.
Right. Mathematically, it has to be.
So with all these indicators flashing by, but the stock just consolidating, are these lagging indicators trapping retail traders who think the 42% rocket ride is just going to keep going forever?
That raises a really important question about the danger of pure technical analysis. Relying solely on historical averages after a massive fundamental shift is incredibly dangerous.
Yep.
Consolidation phases are treacherous because indicators like moving averages stay green for weeks, even as the actual momentum stalls out entirely.
Wow.
The chart tells us what happened yesterday. It cannot tell us that the underlying valuation of the company actually justifies breaking through that $88.88 resistance level tomorrow.
Okay, so what does this all mean for the underlying value? Are we looking at an undervalued gem or a classic value trap? Let's analyze Wall Street's consensus first.
Let's do it.
Out of 26 analysts covering Cisco, there are 16 strong buys, 1 moderate buy, 9 holds, and exactly 0 sell ratings.
Zero.
The median price target is $89.04, with Evercore ISI putting out a high target of $100 and HSBC at the low end with $69. But the real conflict lives in the valuation metrics themselves.
Right, the models.
Yeah, if you run a discounted cash flow model, it suggests Cisco's intrinsic value is somewhere between $87.05 and $94.10.
And the discounted cash flow, or DCF model, is the gold standard for valuation. It attempts to estimate every single dollar of cash the company will generate from now until eternity.
Which is a lot of dollars.
Exactly.
Yeah.
And then it uses a discount rate to calculate what those future dollars are worth today. Because, you know, a dollar 10 years from now is worth less than a dollar in your hand right now due to inflation and risk. The DCF model is looking at Cisco's pipeline of AI orders and concluding that the future cash generation is going to be so massive that even at $82, the stock is technically trading at a discount.
Okay, but look at the relative PE metric. The price-to-earnings ratio is sitting at 29.4x for Cisco.
Yeah, that's high.
A legacy hardware company historically trades with a PE in the mid-teens. A 29.4 multiple suggests a massive premium. So I'm going to argue the value trap angle here.
Go for it.
When you combine a historically weird 29.4x PE multiple with that 19% drop in operating cash flow we discussed at the start, well, that looks like a trap.
I see what you mean.
The market has priced in all the AI perfection, but the actual present-day cash generation is lagging behind the narrative.
But if we connect this to the bigger picture, the undervalued perspective relies entirely on a business model transition.
Okay, explain that.
Yes, a 29.4 multiple is wildly overvalued for a company that just sells metal boxes and routing cables. But Cisco is aggressively shifting away from hardware and transforming into a high-margin software, security, and AI infrastructure company.
Ah, okay.
The analysts assigning zero-sell ratings aren't looking at the legacy hardware business. They're looking at the recurring revenue models.
Which changes the math.
Entirely. When you transition to software subscriptions, your earnings multiplier naturally expands because the revenue is predictable and sticky. If they successfully execute this pivot, that 29.4 PE shrinks rapidly because the earnings will explode upward to match the price.
That is exactly why retail traders often get trapped. They look at a single metric, you see a high PE and think, it's overvalued, I'll short it, and then you get run over by the software transition. Yeah. Or you see the DCF model saying it's worth 94 LARs, so you buy blindly, completely ignoring that their operating cash flow is currently tightening up due to supply chain costs.
Exactly. Valuation is a massive tug-of-war between Cisco's legacy history and its AI future.
Well, to settle this debate, we have to look at the real-world catalysts pulling on that rope. Let's start with the bull case. What is the best case recovery scenario that actually sends this stock to Evercore's $100 price target?
The bullish scenario is entirely built on executing two massive initiatives. First, Cisco has laid out an ambitious target of $5 billion in AI infrastructure orders for fiscal year 2026.
$5 billion.
Right. And this relies heavily on their Silicon One chips. These aren't standard processors. They're highly specialized chips designed specifically to route the unimaginable data loads within AI server farms without bottlenecking. If they hit that $5 billion target, the market will reward them.
And then there is the $28 billion acquisition of Splunk.
That is the second pillar. Splunk is a data observability platform. It basically allows companies to monitor everything happening across their networks in real time, predicting security breaches and system failures before they happen.
Which is huge.
It is. By integrating Splunk, Cisco isn't just selling you the router, they're selling you the high-margin software subscription that monitors the router forever.
Sticky revenue.
Exactly. If that integration is seamless, combined with their 2.04% dividend yield, the stock could absolutely shatter resistance and march toward $100.
But we have to look at the bear case, the worst case continuation lower that cracks that $71.96 support floor.
Right.
Because there are heavy macroeconomic anchors pulling it down. Rising memory component costs are directly eating into their profit margins. There is a broader industry trend of hardware commoditization, where networking gear becomes a race to the bottom on price because competitors can replicate the hardware cheaper. And then we have the looming threat of tariff impacts under current global trade policies. If these risks compound on top of the already lower free cash flow, the foundation just breaks.
Yeah, and look, staying totally neutral in the politics of trade here, tariffs function mechanically as a direct tax on global supply chains.
Right.
If Cisco relies on a complex web of imported components to assemble their hardware, a tariff immediately increases their cost of goods sold. When that happens, the company faces a brutal economic choice.
What are their options?
Well, they can absorb the extra cost, which crushes their profit margins and makes that 29.4 PE look dangerously inflated. Or they can pass the cost on to their customers by raising prices.
Which risks demand destruction.
Exactly. And that jeopardizes that critical $5 billion AI target. It's vital to think critically about how macro policies directly dictate micro profits.
Wow. Okay, we have unpacked the record revenue, the dropping cash flow due to inventory builds, the autopilot index buying, the retreating shorts, the scheduled insider selling, the technical consolidation, and this massive fundamental tug of war between hardware history and software future.
It's a lot.
It is. So let's synthesize all of this into a concrete outlook for the listener.
Okay, well, in the short term, like over the next few weeks, the data points toward a slight downward drift, settling closer to the $81.17 level by mid-April.
So just normal digestion.
Yeah, this is standard market behavior.
Yeah.
The consolidation phase needs time to play out as the market digests the massive 42% gains and waits for new fundamental data.
Right. And looking at the long-term outlook, the survival of this massive rally rests entirely on hitting that $5 billion AI target and proving to Wall Street that the $28 billion Splunk acquisition wasn't just an expensive mistake.
The narrative has to match reality.
Exactly. They bought the AI hype. Now Cisco has to deliver the cash. And we know exactly when that test's coming. Circle May 20, 2026 on your calendars.
Oh, yeah.
That is when Cisco drops their Q3 FY 2026 earnings report, and it will be the ultimate proving ground for everything we have discussed.
That earnings call will definitively answer whether the operating cash flow dip was just a temporary inventory build to secure supply chains or the beginning of a structural margin problem caused by rising costs.
Right.
So keep asking questions, keep demanding explanations for the data, and don't take surface-level price action is the whole truth.
Love that. So here is a final provocative thought to mull over before May 20th. We have spent this entire time debating Cisco's dominance in AI routing hardware. But what happens if the physical architecture of data centers changes entirely? As billions in venture capital pour into quantum networking technology that transmits data through quantum entanglement rather than physical silicon and cables, is Cisco's massive pivot into AI hardware building the ultimate bridge to the future, or are they just building the fastest horse buggy right before the Model T arrives?
That is the question.
Keep digging, keep questioning the narrative, and thank you for joining the deep dive. Make sure to subscribe, leave your feedback in the comments, and we'll see you next time.